and start the webinar.
Cool.
Hey, everybody. Thanks for being here today. Just a couple of quick Zoom housekeeping things. I'm going to send a hello in the chat box to make sure we're broadcasting because we can't always tell that we are. If somebody doesn't mind saying hello back, that would be awesome. As usual, we are broadcasting from multiple locations here. I think we have Jeff in Florida. Ed, you're in New York City?
Yes.
And I can brag that I am once again in Cabo, enjoying the beach and the sun and trying to do my best to pretend I'm working. So we have a friend a new friend, Jamie Lesher. I see you're on there. Jamie is responsible for creating the nexus of connectivity to Nimali and Ed and Jeff and Nimali. And I'm just grateful that we're able to connect that way, Jamie, and thank you for doing this. So we have a bunch of folks that are just populating the webinar here. And so just a couple of housekeeping items. Please feel free, and you're welcome to, and we encourage you to ask questions in either the chat box or the Q&A. I know most people are familiar how to do all that. And so we'll get to them as we go along here, as many as we can. We have an hour with our friends, and we're going to be posting this for the record on the Family Office Insights YouTube channel once the recording is done. Take a day or two. And we can't see or hear you, but as I mentioned, please feel free to ask any question as we go along here. We'll do our best to get to them. So with that, am I giving it to you, Jeff, or Ed?
Ed's going to start, but I'm going to make one quick statement to clear one item up because it always comes up. The name Nimali is not the next location that Arthur's going to on vacation. Not a Polynesian island or something like that, although it might well be. But Nick, Max, and Lindsay are my three children.
Awesome.
The first two letters of each of the names. So that we can get that out of the way now. And now to the important part of the broadcast with Ed, please.
Yeah, that's great. Thank you. Go ahead, Ed.
Well, thanks, Arthur, and nice to have everyone on today. I'm going to just share my screen. We have a bit of a presentation to walk through. So just give me one moment. So hopefully that's up for everyone that has dialed in, has linked in with Zoom. So going through briefly, safe harbor statement, which all of you have seen before, but to the important stuff. So Nimali was formed a couple of years ago, really with a focus of bringing renewable energy investments to high net worth, sophisticated investors. We'll discuss the markets a bit more momentarily, but generally speaking, most renewable energy investments over the last 10 to 15 years have been financed by and large by corporates, which have taken advantage of some very nice tax benefits. What Nimali's done is figured out ways to offer these investments to individuals at scale. So not one off here or one off there, but really on a programmatic basis. And between Jeff, myself, and our other partners, we have a very strong track record, both in finance overall, running different funds over the last couple of decades, as well as specifically in the renewable energy sector. Renewable energy projects over the last 10 to 20 years have become very, very predictable. We'll talk a bit more about the technology, but effectively solar came out of the space program, and since then there have certainly been improvements on the technology, but it's very predictable, very understandable, not a lot of moving parts. And so Nimali is set up to offer investment opportunities all across the US. We'll get to one specific program that we're quite excited about in New Jersey at the moment, for which we're targeting to raise about $50 million in equity to do roughly about $150 to $200 million of projects. That program rather takes what's already a very low risk, high expected return investment and lowers the risk in a couple of ways even more, and we'll get to that. Kind of getting to the main point up front for every potential investor, one of the things we really like, and Jeff will talk about his background, I'll talk about mine, we both worked for various different types of investment funds over the years, The structures that we're looking at, there's a couple of different flavors, but the default structure basically means that for every dollar an investor invests with us, within the first year, they're going to get $1.40 back in benefits. So that's really obviously a very good return overall, but also lowers risk tremendously because effectively within the first year, you're out of your investment. And right now we're really finalizing our first couple of investments under the program, and we're going to be rolling that out in the next 6 to 12 months. So jumping into the solar market, and some of you may be very familiar with this, so apologies, but we thought it would be useful to talk a bit about solar overall. Solar, from a sense of electricity generation, has really been around since the 70s. There was a boom in the 80s, then there was a bit of a bust, and there have been a couple of boom or bust cycles, really until the last, say, 10, 12 years or so. And since that time, the industry has just grown tremendously, and you can see the chart on the upper right. Since 2009 to 2019, the percentage and the capacity of solar that's been built across the United States has grown massively, to the point that as of last year, solar actually is the largest percentage of energy that's being built in the US right now, which is pretty surprising. It's more than natural gas, it's more than coal, it's even more than wind. And so solar is really booming. Even with COVID this year, the industry has been growing. It's expected to do at least as well this year as it did last year. So this has really become a very established sector, a very large sector, and it's expected to continue to grow even more. I think about 37% of installations last year were solar, and that's expected to grow to at least half, if not more, over the next 10 years. So basically big market, which we like a lot because that provides a lot of investment opportunities. So speaking specifically about what we would like you to consider today, in New Jersey, Nimali's identified about a $50 million equity opportunity for solar investments. We can actually make that a bit larger depending upon appetite, but we think that's really the sweet spot. We've talked a bit about solar being a mature technology, so you can read that as you wish. But basically the program that we're focused on will really focus on small and medium scale solar projects. So these are generally projects that are selling to commercial entities, nonprofits, educational institutions, and oftentimes they're on rooftops, sometimes they're on carports, sometimes they're on the ground. But what we like in particular about this program in New Jersey is when you sell the power from generating the electricity in solar, you get the payment normally from the end user, which is an important part of your revenue stream. But in addition to that, the state's actually offering what they call a renewable energy credit. And they've had various formats of that program for about 20 years now. But the program that's on right now is called a TREC, a Transitional Renewable Energy Credit. And what's particularly special about that is that instead of getting the credit and then having to go to the market and sell it, the state actually, you get the credit and then they guarantee a payment to you for 15 years. So basically you have a fixed known revenue stream backed by the state of New Jersey for 15 years, and that provides roughly about 3/4 of your revenue. So it really is quite a nice additional risk mitigant and really helps understand where your revenues are going to be for a long time. As I mentioned, in addition, on top of that, you also do get revenue from selling the electricity to the end user. We're generally not selling to intermediaries. So we're working with an engineering firm in New Jersey for this project, where the projects would go on rooftops, et cetera, and would be used generally right at that facility. We'll talk more in the next slide as I turn it over to Jeff about where the returns actually come from. But at a high level, basically, there's three pieces. There's federal tax credits, there's losses that offset taxable basis, and then there's a bit of a cash yield on top of that. So with that, I'm going to turn it back over to Jeff to talk a bit in more detail about the return overview.
Thanks, Ed. Just by point of reference, before I get into solar and the returns here, which I think are quite interesting, I was just looking in the marketplace and I saw JP Morgan issued a 14-year CD yesterday. It has a 2% coupon, and they were subscribed for billions of dollars in the matter of minutes. The part of our solar returns that we rarely talk about is the 2 to 3% cash yield that we give. And I'm beginning to think maybe we've missed the boat. We should just talk about that and not talk about the 140% after-tax benefits you get from tax credits and depreciation. But be that as it may, we like solar because it is uniquely stable and uniquely not correlated with anything. The returns from these projects are very stable and very predictable. The first part of the return comes from the investment tax credit, where the government gives you 26% of your qualified costs, which typically is what you invest in the project. So for example, in a $10 million project, you would probably get approximately 2.6 million of investment tax credits, which are dollar for dollar offsets. And you get that as soon as the project is operational. So most of these projects don't take 6 months to build. You would be getting that credit within a 6 to 9 month period. Keep in mind, on a $10 million project, your equity contribution might be around $3.5 million. So if you're getting 26% of the 10 million or 2.6 million back, you're getting a big chunk of your money back very quickly. The second area where you get a great deal of return is in the losses. There is very favorable tax treatment on these projects by way of depreciation. And again, in my example of a $10 million project, the way the depreciation losses are used or calculated is you have 10 million of essentially basis, and that would come from your equity contribution and your recourse debt. And I'll get to the question about recourse debt a little later. The government takes back half of your investment tax credit as a reduction of what you're allowed to create losses with. So your 10 million creates 8.7 million of losses. If you're a full taxpayer, federal and state, your rate's probably around 40%, and your tax benefit would be 3.4 million, 3.5 million after tax. You add that to the 2.6 from the tax credits, and you're looking at close to $6 million of after-tax benefits on a $10 million project, of which you put in perhaps 3.5 million of equity. That's a very, very good rate of return. We conservatively, target at 40, and that's after tax within a year. I don't know and have not been able to find anything else in the marketplace that vaguely produces that kind of after-tax return with the certainty that comes from these kinds of investments.
Jeff, would you mind if I just asked a quick question, and I can wait if you do?
Arthur, it's your toy. You can do whatever you want.
So others may be thinking the same thing. Super attractive. Do you harvest most of these goodies in the first year? And if so, if not, when? And how long is the duration to harvest them all?
Excellent. Excellent question. Cabo has not softened you up at all.
We'll see.
Yes, the credits are available to you as soon as you turn the project on. It becomes operational, and most of you are probably quarterly estimated payers, so you would get the benefit in the quarter that you turn the project on. The rest of the benefit comes with the depreciation, which again you can estimate as you go, but typically you'll take it at the end of the first year. So your average time frame for getting all your return is typically a year or less. Now, what happens is you don't have any more depreciation shield after the first year. And what you do get is you do get some cash return of 2 or 3%, but for the remaining years of service of the project, which we estimate at 15, you're going to have some income and you're going to have a small tax burden each year as a result of that, because you're actually making money and you've gotten all the benefits of the losses day one, and then you're picking up the income over a 14, 15-year period. Does that make sense, Arthur?
It does. And so if I'm understanding it correctly, you harvest all the goodies or most of them in the first year. And in order to offset the coupon in the for the balance of the 13 years, you can allocate some of the depreciation to them as well.
No, I'm gonna have to say that one I can't agree with.
Okay.
What happens is, because you have no more depreciation, all you have are the straight operating revenues and deductions. So again, on a $10 million project, I'll make up some rough numbers. You might have $1 million of revenues and some hundreds of thousands of dollars of expenses. And you also have debt payments, some of which are interest, some of which are principal. The interest is deductible, the principal is not. And what you're left with is some taxable income, because you have real income. Your revenues exceed your expenses, and of course you don't have the deduction for the cash you're paying for the principal repayments.
Okay, so that's not entirely a bad thing, because you harvested, you have some income, you pay tax on it, but you harvested all the benefits of in the first year. And so if you didn't have any taxable income in the first year, then you probably wouldn't want to do it. So you want to do it in a year where you have taxable income.
Correct. Currently, the way the law is written is you're allowed to take your losses back in time. Okay, there's a 5-year look back for NOLs, but that provision is part of the bill that the government has worked on. It was part of the health bill, the COVID bill.
Yeah. And
that, even though that provision of utilization of NOLs is set to expire on 12/31/2020, we're being told, or we're being informed, it's part of the negotiation to extend that. But as of right now, you wouldn't really be able to go back in time, except for the tax credit where you're allowed to go back 1 year. The losses would have to be carried forward. And of course, if they're carried forward, it's not the worst thing in the world, because the income you're generating will then be sheltered.
Exactly. Yeah.
You'll end up with tax-free income later.
So I stopped you, and then we have a bunch of questions, but do you want to continue or take questions?
I think I'd like to go to the next slide. I think the questions that are going to come up are going to be questions regarding active and passive income.
Exactly.
That's important. And the question of recourse or non-recourse. And the question of a corporate form or an individual form. And if everybody will give me a minute or two, I'll get to them in general terms, and then we can delve into them specifically.
Perfectly. Yeah. And
Okay.
of course.
Ed, if I may have the next slide. So I ran a hedge fund for 20 some years, and we did non-merger arbitrage. We created real income and mitigated risk terrifically, and we've never had an investor lose money. And nothing I ever did had the risk return parameters and the safety parameters that this solar energy investment has. And the reason I say that is because the solar technology in and of itself is well defined. There aren't any moving pieces in this project. The panels need to be pointed south. Most people can figure out where south is. We have a contract with the state of New Jersey for 15 years that is a fixed pay contract. The panels themselves come with warranties as to their ability to produce power for a set period of time. And the panels also don't run on just sunlight, but they run on solar radiation. So the estimate of the amount of power you're going to get every year is extremely tight, typically within 0.5%, as is the degradation curve of the panels. They get less potent over time. So you have a very, very small band of projected revenues. In the New Jersey case, the state is providing approximately 3/4 of the revenues. And you're getting about 1/4 of your revenues from selling the power to somebody, or if that person isn't there, into the grid. And I should mention that the TREC payments, the state of New Jersey payments, typically cover the debt costs. So you don't have any kind of major risk there. And because of the investment tax credits being statutorily 26%, and the contract with the state being set at what it is, and the depreciation rules being established, the outcome is extraordinarily predictable. You know, you're going to get these numbers within reason, absent or without, you know, relevance to a change in stock market or a change in interest rates. So by way of diversification and safety, this is a unique investment with a very high rate of return. I am, and Ed will, I think, vouch for me, I am a finance monkey. I am not a solar guy. I am a CPA with tax background many, many years ago, but we've combined between Ed and myself and our other partner, Nick Masucci, who we'll describe briefly, a well-experienced and broadly knowledgeable team. And what we've done is we've simplified the structure for solar. We've made it a single equity owner and a single debtor. And this is not how most solar deals are done. I'm not going to go into the competing structures, but this is a slightly different structure than most people use. And it does provide simplicity, and it does provide an easy calculation of risks and returns. Ed? The team is myself. I was one of the founding partners with Ed and Nick. Again, my background is financial. I ran Palladin, the Palladin Group, for 20-some years. It was a non-merger arbitrage hedge fund. I started it in 1987 when there were about 300 hedge funds. We produced in our primary funds about 7.75% more than the 90-day Treasury bill for 17 or 18 years. And we've never had an investor lose money, which I'm very proud of because I am an awful loser. I also I was a co-founder and the chief investment officer of a fund called Imperium, which was started in 2005, 2006, and I managed through January of 2011. And even through 08 and 09, that fund made between 6 and 9% each year. My real strength is financial. It's in structuring and mitigating risk, and in producing positive returns. As I mentioned a long time ago, I was a CPA. I'm also an MBA. Ed, would you like to describe yourself, please?
Thanks, Jeff. So I actually am also a finance guy, but I'm also a solar guy. So I've worked both on the buy side and the sell side, primarily in investment funds across innovation, energy, technology, healthcare. And then really over the last 10 to 12 years, I focused on energy. Initially, I was working at BP in their solar division, working on medium to large scale projects, both in the United States as well as in the Asia Pacific. Got a number of promotions, so I was ultimately running that team. And we were doing everything from half a megawatt rooftops for Wal-Mart in California to very large scale projects in the United States and Australia and India, really developing through building and then financing. Subsequent to that, I worked as the CFO for a traditional energy company out in the Pacific Northwest that was doing a world scale methanol facility, rather complex project financing, where we worked with a number of large infrastructure funds here in New York, various different sovereign debt pieces, as well as traditional bank market debt. So I've been around the block, both as an investor as well as in-house, probably about 100, 150 megawatts of solar projects that I've worked on that are operating now around the world, and really kind of know a lot about the nuts and bolts of how to make sure to keep things on track, really from the get-go. So that's a bit about my background. Our third partner, who wasn't able to join today, Nick Masucci, brings the engineering background to the team. So Nick is now semi-retired, but he was the CEO of Lewis Berger, which is one of the largest engineering companies in the world. They do quite a lot of work for the United States government, a lot of civil engineering, and then they developed a practice in solar as well. So where Jeff has a lot of expertise as CIO, structuring, I straddle the worlds of finance and solar. Nick really is our engineering guru, both as we focus on making sure projects are built on time and on budget, and then help to manage the operations once they go into production. So that's really the team overall. We think we have a lot of good pieces of the puzzle here. And with that, I think we wanted to just walk through a couple of specific case studies and track record, both on the fund management side as well as the solar side. So for the fund management piece, I'll turn that back to you, Jeff.
Okay, and before I get into the fund management, which I'm going to really go quickly with, I just want to go through a couple little things that I said just to clear them up a little better. The installation of these solar panels typically takes less than 9 months. This is, again, a low-tech business, and it's not a new business. There's nothing particularly complicated about putting the panels on a rooftop and running cable into the grid or into local businesses for power. So the likelihood of projects being done on time within 9 months or so is very high. With regard to the generation of the benefits, it's as I stated, the credits become available to you when the project's turned on. It becomes operational, and the depreciation is as the money is spent. But typically, you can look towards the end of the year to take the depreciation benefit. With regard to the state of New Jersey paying the credits, the funding for the payments from the state of New Jersey, which are a function of the power you produce, you are paid upon production, not upon sale of the power, but the production of the power, is from a fund managed by the state of New Jersey, but funded by the utilities in the state. It's not part of the New Jersey general budget, and therefore, if people are worried about the state of New Jersey's credit, this has a separate funding and is not subject to the state legislature messing with it. But having said that, on the screen is a bit of the history of some of the assets I managed. Again, just by way of demonstration of risk management and ability to produce rates of return. The Halifax program, which is on the screen, on the left of the screen as I'm facing it, was a direct investment program where we went directly to companies and bought paper from them, be it convertible bonds or senior debt warrants. And we produced an annualized rate of return of 15.39%. Palladin Partners, which was which was our general investment management program where we did all types of non-merger arbitrage, produced 11.43. And Imperium, which ran from 2006 through 2011, was senior debt with warrants. And again, none of them produced negative returns to any investor over the life of the investment. Next screen, please. The numbers are a little small here, but this is the Halifax Fund. And this is where we were making direct investments in public companies. These were PIPE investments, private investments in public entities. And we were the largest PIPE creator during the 1990s, larger than Goldman Sachs and Merrill Lynch. The rates of return are a little deceiving because we went into liquidation in 2000. So according to SEC rules, you have to publish whatever the rates of returns are, which is true. But the period 96, 97, 98, 99 was the period where I was managing hundreds of millions of dollars. And 2000, 2001, 2002 were, less than 9 digits. And in the last couple of years was probably, less than 25 million bucks being managed. But you have to report the numbers per whatever they are. So if you looked at the actual amount of money these people made, they made way more than the compounded 15%, because most of them got the money out and then they earned 2% when maybe 5% of their investment or 10% of their investment. So again, we tried to manage it as best we could. And when the market was not there in 2000, if any of you remember the year 2000, we quickly exited the market and did what was best for the investors. Ed?
Great. Thanks, Jeff. So to complement Jeff's track record as a CIO and really understanding the market, I've worked for a number of different investment funds, but particularly in the Nimali context, what I'd like to talk a bit about is just our solar experience. As I mentioned, after working in New York and London and Shanghai, came back to the US in the late 2000s and joined BP in their solar division, really right when the solar markets were starting to take off again. So at that time, BP was actually still a module producer. They were a manufacturer. They learned to exit that business a while ago. But they were really focused on doing engineering and doing development of projects, some of which they own long-term, some of which they would then sell to financial investors, such as folks like Nimali. So I worked on everything from Wal-Mart rooftops, which I'll talk about on the next slide in a bit more detail, to engineering and constructing large-scale projects in California. I helped build our strategy in various different new markets that were exploding, India, Australia, and then also was involved in what was then the largest solar project in the eastern part of the United States in Long Island at the Brookhaven National Lab, and that's a 37 megawatt project that we did with MetLife and is still operating quite nicely and producing returns. In addition to solar, as I mentioned earlier, I also was the CFO of a methanol developer that was a US-China play. I lived in China for a while, speak Mandarin, although that's less relevant for Nimali. But really understanding how things work and different financial structures to bring things to market. So been around the block and understanding just how to get things done from, from identifying land through permitting, through construction, etc. Nimali itself will focus on projects from the point at which they're entering construction into operation. We are not going to take development risk. That's a very different trade-off, much higher risk than what we would like to offer our investors. So talking a little bit more in detail about Wal-Mart, so obviously very good credit. In the kind of mid-2000s, Wal-Mart decided that they wanted to basically have 100% renewable energy for all their stores. They continue to work on that objective, and we've actually looked at some Wal-Mart portfolios ourselves recently. But they initially issued a request for proposal, and BP was one of the awardees to just effectively test out the strategy. BP performed very well, and so we were awarded about 20 additional sites to build across the United States, primarily in California. And so my team was basically responsible really for the construction phase and then the operating phase, and making sure the projects were built and delivered on time, on budget, which we did successfully. So ultimately, BP did about 20 sites for Wal-Mart across California in that program, displacing roughly about 30% of the energy consumption of each store. And so very successful program, and really helped Wal-Mart launch on their way towards getting to 100% renewable energy, which they continue to roll out both in the United States as well as abroad. So overall, we have quite a strong background in solar, understanding how to make sure that things that already have relatively low risk are de-risked even further. So with that, I'll turn it back over to you, Jeff, to talk about next steps and how investors can really take advantage of the growing solar market.
Thanks, Ed. I guess I said this 6 times, but I'll say it once more. If I were running my hedge fund, this would be something I would look at immediately, because the risk return profile, given its predictability, is extremely unique. And I think given the structure we've come up with, which is very simple, a single equity owner and a single debt structure, really works well. There is some complexity to this and some clarity you need in order to determine whether this makes sense for you, where it doesn't. The first level of question is are you an individual or a corporate investor? Individual investors can potentially have far higher after-tax rates of return than corporate investors. And the simple reason is the corporate tax rate is 21 federally, and the individual tax rate federally is 37. Certainly losses produced that give you a 37% shield are worth more than losses at a 21% shield. But if you are a corporate investor, I think we estimate, Ned can correct me, that the rate of return on the project, the IRR, is going to be between 15 and 25. Is that right, Ed?
It is, that's correct.
Thank you. Which is still a wonderful rate of return. One of the benefits, if you're a corporate investor, is that if you put debt on the investment, if you have a solar project and you have debt assigned to it, whether the debt is recourse or non-recourse, you get all the tax benefits. Meaning, even if the debt does not have any further liability than to the specific project, you still get all the deductions. So in the $10 million example I used earlier, if you had $3.5 million of equity and $6.5 million of non-recourse debt, you would still have the benefit of $8.7 million of depreciation expenses or losses. And that's a big advantage. The question of recourse or non-recourse is very relevant for individuals. Individual investors, in order to take depreciation, need to have something called basis. And maybe it's good now if I give the broad disclaimer again that I am not giving tax advice today. I am not your tax advisor, and you cannot rely upon me or Ed or even Arthur for tax advice today. You need to talk
That's
to your
for sure.
you need to talk to your own accountants or lawyers for that. But we've done substantial research and spent a serious amount of money making sure we think we have the right answer. Having said that, individuals, in my example, if you had 3.5 million of equity and 6.5 million of non-recourse debt, would only have 3.5 million of available depreciation in the first year. So their return profile would be slightly different. If they had the 3.5 million of equity invested, they would still get the 2.6 million of investment tax credits. That's unaffected. But they would only get 3.5 million of depreciation shield. And 3.5 million at 40% is worth about 1.4 million after-tax dollars. Added to the 2.6 would give you 4 million on your investment of 3.5. Again, a nice return, but because you haven't used up all your losses, as you produce income over the next 14 years in the project, for I believe approximately the first 8 or 9 years, that income will not have any tax, because as you create income, that counts as basis. And when you have the basis, you're then allowed to use your losses. So you have a timing difference in when you get the losses. Certainly better to get the losses day one. Okay, you get the after-tax benefit of all those dollars for all those years, but not terrible if you choose not to. We think, given the low-risk nature of the revenue stream, you should take non-recourse debt and get all the benefits and have the higher rate of return. But even so, it's quite a substantial rate of return. It's north of 20%. Now, the other big question is whether you're an active or passive investor. And I'm not going to go into all the distinctions here, but typically, active investors or people who have active income will have income that is wages, salaries, bonuses, capital gains, interest, dividends, things of that nature are considered active income. Passive income generally comes about, as the word implies, where you're just an investor in something and you're not a participant in the process, although it's a little more defined than that. Typically, real estate is considered passive. If you are an investor in a private equity partnership, that would typically produce passive income or loss. And depending upon how you choose to be an investor in solar, you have a choice of being an active or a passive investor. If you invest in our fund, you are a passive investor, and you would have to have passive income in order to get the tax benefits. We are able to set up investments that are of the same nature of our fund, but are managed separately, and they can be active for investors if they choose to go that way. There's a good deal of information that surrounds these decisions. We have year-to-year projections based upon individual or corporate, and year-to-year projections, whether you choose recourse or non-recourse debt. And if you have a further interest, please contact Ed or contact me, and we will be glad to provide you much more information about what constitutes active or passive and give you the annual projections of individual or corporate investors and recourse and non-recourse debt users. So otherwise, in this limited time, in this limited setting, I think it's just too much information and too detailed to go into.
So Ed, that's super helpful. and you basically answered all the questions that were proposed in the chat box, mostly, but I'll see if there's other ones. And I tend to oversimplify things. So if you're an active investor, you're an individual, and you take recourse debt, and I know you're not giving predicting rates of return, or you're giving tax advice, but what's the IRR in that case?
Well, if you can use the losses, be you active or passive, okay, and you are an individual and you have the non-recourse debt, your IRR should be north of 40.
Sorry, Jeff. Sorry not to interrupt. The north of 40s with recourse debt.
With recourse debt.
Recourse debt,
I said
right.
that backwards.
Yeah.
Recourse debt. And weirdly, you get almost all the benefits in the first year.
Which is interesting.
People predict these giant IRRs, like in private equity investments. You put your money in, and then 8 years from now, you sell it for some enormous amount of money.
Yeah.
God bless you if that happens.
Yeah.
But in this case, it's by statute. You get the tax credits, you get the depreciation, and you got all your money. And then you happen to get 2% a year for 15 years. And for the people who do want to take it the next step and look at our projections, the numbers we're giving you assumes there's nothing at the end, which may or may not be true. We may be able to either extend the life of these projects, in which case they become very cash flow heavy because you have no debt assigned to them. Or second, we might be able to sell the projects for real money, in which case you get more real money.
Yeah. So the liquidity and the commitment in terms of duration, let's just say you do a project on your own with you set it up so it's active. And I know there's lots of issues with that, but you put $3 million up, you buy a $10 million project, you finance it.
Yep.
That $3 million has a lockup of 14 years, independent of what you're going to harvest in the meantime, but that commitment is for 14 years?
Let's say it's 15 in the way we think about it. So you should get 4.2 million or 4 million or so, let's say 4.2 million in after tax benefits the first year.
Right.
Okay?
So it doesn't matter whether your money's locked up or not, you got it all back. Right.
Exactly.
We're going to force you to take, $60,000 a year for 15 years, and you might get another lump sum at the end.
I got it.
That's it.
And if you're in a position to harvest the tax benefits, there's no liquidity provision. Like if you wanted to bail for whatever reason.
Bailing is a bad plan for a variety of reasons. The way the investment tax credits are set up is if you bail in the first 5 years, the investment tax credit is clawed back pro rata, so by year. So they give you all the credits in the first year, but if you bail in the third year, they make you give back 40 to 60% of them. So you sort of vest 20% a year on your tax credits.
I'm going to oversimplify it and I'll get hung for it. But what you're really doing is taking $3 million and trading it for 4.5, and you're done.
Yeah, it's exactly, Arthur. So you're basically trading it for 4.5. The contracts run 15 years, but you're out with your returns. Right. I mean, you're from a financial standpoint, there is a legal obligation for 15 years, but coming back to one of the things Jeff said earlier, there is a debt payment that's due for the next 14 years, but you're getting a payment in the New Jersey example from the state that covers that debt payment. So there's still some paperwork that happens over the next 14 years after that first year, but from a risk profile, you've gotten your return. There's, there may be a little kicker after that on a yearly basis, or if we sell the project at the end, but it's not like you're waiting to year 5, 6, 7, 8 to get your investment return. You're really getting it all within that first year. And one of the things also to mention, the IRRs we're talking about, we've actually annualized them. They're actually even a bit higher because, as Jeff mentioned, you're getting your tax credit. You're getting your tax credit effectively within, it's called 4 to 6 months of investment in most instances. Yeah. So that's even better than what we're projecting.
So does the New Jersey payment, let's call it that, is that covers the debt carry, but does it also cover the 2 to 3%, or the 2 to 3% is in addition to that?
So the 2 to 3% roughly, it's about even. You're still getting about 25% of, in the New Jersey example, 25% from sale of the power to the end user. And I think, as Jeff touched upon, if for whatever reason the end user decides not to pay, which is pretty unlikely because they're generally getting cheaper power than they could buy from anyone else. But if for whatever reason they decide not to, you can still sell that power into the grid. So that revenue stream is still there. So the 2 to 3% is basically right at the margin of where the New Jersey payment is, but it's largely covered by your additional revenue. And there are some operating costs, right, which are also covered by your additional revenue as well. But basically, you're looking at an investment where you have a very predictable revenue stream for 15 years, a very predictable cost structure for 15 years. And instead of waiting for your benefits over that 15-year period, you're getting 90+% of them upfront in year one.
Okay. Arthur, just to be clear, the contract we're selling the power under is also a 15-year contract generally. So we're going to somebody and saying, geez, it's costing you 10 cents a watt or whatever today. We're going to sell it to you for 7 or 6.
So you have a power takeoff agreement that already is
right. That covers it for 15 years.
Right, and so the risk is the
credit goes
of
away
right,
or something.
Counterparty risk of the payer, right? So,
and we try to be careful with that. The other part is, and I'm sure I should have mentioned this. The government wants people to do this. The government is incentivizing people like crazy to build solar. This is everybody. This is Congress, the president, whoever. So I know people worry about audit risk and having the government snooping or smelling after them or something, whatever you want to call it. This is not an audit flag, okay? This isn't something that triggers an audit, okay? And it's clean. There's contracts and there's tests that you meet. Now, if you're passive, it's really easy because you're getting a K1. If you're active, the way we have it set up, and we haven't gone into all the detail, you also get a K1, which makes it a lot easier with regard to having to put all the functions of what are going on in this project on your tax return, on a Schedule C, where you'd have to show line by line by line. We recommend, and again, we haven't gone into it because we haven't gone into all the detail, and we have local accountants who are expert at this and have done this for years, produce the K1 that gives you the proper reporting. So I think people should be aware of that.
You've thoughtfully answered, again, many of the questions that are coming up. Maybe you're seeing them there, but is this is not considered a listed transaction, like anything like that, right?
No, there's no securities laws. The structures we recommend is we recommend creating a LLC, a specific LLC. If you want to do it as an active investor, be your own, you set up your own LLC and have 2 members. We could be the other member, we don't care. And if you're in the fund, it's it's a private placement. We're careful with that, but you get a K1. That's it.
So
Arthur, if I can, just one thing we didn't mention, we probably should have. Obviously, we have investment projects all across the United States. We've talked a lot about New Jersey. You don't have to be in New Jersey to invest in the New Jersey projects. You could be anywhere in the US and get those benefits. The projects themselves are going to be in New Jersey, but you could be anywhere in the US.
So we're running up against time. So let's talk about capacity, how much you can take in, whether it be through a LLC, SPV type thing, or directly into the fund. What's the, how much can you take in, and how soon do you want it?
Go ahead, Ed. I know you like this part.
I'm happy to take this one. So as I mentioned earlier, Arthur, we're pretty comfortable in New Jersey at about the 50 million level in equity. We do have a couple of large, basically, customers that we could do more. We could do a bit less too. As I mentioned, the projects generally are going to be on an individual basis in New Jersey, $500,000 to $1 million of equity, but there's a lot of them. So we can really customize quite a lot. There's a few that are sort of 5 to 10 million investments, but it's really putting together a group of smaller projects in a program. So New Jersey, the sweet spot's roughly about 50 million. We have customers waiting right now, and we're starting to build some of the projects right now. And so that's live. We didn't mention that the reason why it's called the transitional rec program is because it will be replaced. It's going to likely be replaced sometime in the next 6-month time period. New Jersey will still be interesting after that, but you may not have that guaranteed 15-year payment. Outside of the New Jersey TREC program, we have at least as much capacity, if not more. We look at the fund as a $50 to $100 million minimum vehicle. And those projects generally are probably going to be a bit larger. They'll be more in the $1 to $5 million range for each individual project under the fund. And so there, we also have immediate opportunities to deploy capital. And so, but it's more of a longer term statute. The other thing to mention is right now, the investment tax credit's at 26%. That's supposed to drop to 22% next year. The returns will still be good, but they won't be quite as good. Obviously, elections are coming up, so we don't know what will happen after that, but we're assuming that things will continue the way the laws are written. So for an investor looking at this, New Jersey is probably the highest priority, best risk return profile. Behind that, committing capital this year has some pretty substantive benefits in getting that 26% ITC. Does that answer your question, Arthur?
Yep. And so what's the next best guess in what state you'll do this next?
Well, we have opportunities right now in different states around the US. There's a number of things we're doing in New England. We've been looking at some projects in Florida, for example. California, obviously, continues to be a booming, if competitive market. But what's really interesting, Arthur, is we recently looked at a project in Indiana. And I can tell you, if you had asked me a few years ago, would I be looking at a fairly large scale solar project in Indiana, I would have thought you were crazy. And so the opportunities really are all around the US at this point. We, as I mentioned, probably have a bit more of a focus right now on the Northeast, Florida, and then kind of places like Arizona and California that are more traditional solar venues. Great.
All right, so you guys did a really great job of answering a lot of the questions that were proposed, and there was a whole bunch of them, and you'll see them in the transcript. And for those of you that asked the questions that we didn't get to, yeah, you're certainly willing to, and certainly able to contact Ed and Jeff directly, and we'll make that happen. Can we go ahead with a little closing remark, and you guys decide which one you want to go first?
Jeff, you go for the closing remarks.
Oh, wow. I wasn't prepared for this. I'm sorry. Look, I've said it over and over. This is a utterly compelling investment if you do the numbers and you measure risk. I mean, in order to get 40% after-tax dollars in a bond, you'd have to invest for 80 years, which is absurd. The equity market, I don't know if everybody's as scared as I am, but if you're not, you ought to be. You know, equity returns, even if you're projecting at 8-9%, is a 5-6 year return profile. That's pre-tax. So, you know, the level of control that you have in this and the level of certainty is very, very unique. And I believe makes rational people behave rationally. This is a good thing to do. I'm not suggesting you put 100% of your money into this. You know, you need to talk to your tax accountants. You need to make sure this fits. You need to make sure it's part of a tax plan. But this is a very, very unique opportunity to increase your after-tax rate of return.
Excellent. Ed?
So I compliment what Jeff said, and this market's growing. It's going to continue to grow. And what we think we're bringing to the table is really the ability for individuals to partake in this market on a programmatic basis. And generally, that's been very hard to do if you're even a wealthy individual. It's kind of in one-offs here and there. We think we found some pretty interesting ways for people to have those returns and to deploy substantial amounts of capital on an ongoing basis.
Hey, Arthur, one last thing, because
Sure.
Ed didn't say it, and I was certain he was going to, because he's a far more sensitive person than I am. This is not only a good investment, but it does good. Green power is a good thing.
It definitely is.
It really is. This is something that, you know, at least my children will not laugh at me about. You know, they believe I'm a bookie otherwise when I trade stocks. But this is a good thing. And that's worth something, I think.
For sure. It's worth a lot, in my view.
Yeah.
Super cool. You guys did great. Really appreciate it. Thank you, everybody, for joining in and paying close attention as you have in your really great questions. I'm sorry I didn't signal everybody out with the questions, but Jeff and Ed got to them as we got along for the most part. But we'll put everybody in touch with each other. And thank you again. As usual, I say, thank you for sharing the only thing you can't make more of, and that's your time. Super appreciate it. The Family Office Insights community has been awesome. Thank you all for being a part of it. And till next time, thank you. Thanks, Ed. Thanks, Jeff.
Thank you, Arthur.